Hello. Today we are going to discuss the outlook of most risk-off assets, so bonds and also yen. Then I will show you a couple of charts on European stock markets, which bounced off their 200-day moving average over the last 2 weeks. And we will discuss the sector outlook in Europe with a significant sector rotation underway. So first point, last week I showed you that there was an excess on bond market, so a potential excess, breakdown below important technical supports, especially on US 10-year bond yields. And what I told you is that the risk was a short-lived decline to 2% on the 10-year US 10-year bond yield, followed by a V-shaped recovery. So it seems that this scenario is correct, because if you look at what happened, so at the start of the week, we almost reached 2%, then reversed. So it seems that last week's decline of US bond yields back to year lows was just an excess, and we are probably starting to correct this excess. So to be clear, I think that the rise we started to see this week could be the beginning of a significant bullish reversal of bond yields. So the first target at 217 has already been reached. Is the first Fibonacci support, and I would favor further rise now to between 225, 230, maybe even higher. 240 remains a big resistance on the upside. Now, if we look at German 10-year bond yields, same story. False breakdown below an important support zone at the end of last week, quickly followed by a V-shaped recovery. So once again, this should suggest that we have seen an important low around 0.30% last week, and that a significant reversal is starting. On dollar yen, a similar story. As I told you last week, we saw a breakdown below an important support zone, 109, 108. As you can see, this breakdown was short-lived, and a significant bullish reaction followed from the 108 support zone. So I consider this to be a bear trap on dollar yen. This looks very similar to what we saw here. So back in April and also back in June. So I think once again there is a significant probability of starting a reversal to 111, which remains the first important resistance, and potentially higher. Now, if I turn to European stock markets, also important price action this week. As you may remember, over the last 2 weeks, I was expecting, I considered the pullback below the 200-day moving average as a buying opportunity. The technical bounce was even stronger than what I was expecting, because Eurostoxx has already retraced 50% of its 2.5 months consolidation process, which is a very fast move. And as you can see here, so the downtrend is now broken. So the bullish reversal is significant. What I would like to see is a pullback in the short term, because the move is pretty fast. And I also noticed yesterday evening the completion of a daily setup 9 sell. We also have a similar signal on DAX 30, which has led the recovery. If I look at other indices, so this is the IBEX 35, so Spanish equities. This one is lagging other European markets. So as you can see, the downtrend is intact. But the good news on this lagging market is that it also bounced off its 200-day moving average. So once again, I think there is a high probability that we have already seen important lows between late August and early September. Contrary to IBEX, so this is the FTSE MIB, so the Italian stock market. As you can see, this stock market was very strong during the consolidation move, which started in May. so it was almost flat, so much stronger than other European markets, and broke out above an important resistance, so 3 days ago at 22,000. So once again, this is a very, very strong chart, and showing a move back to 52-week highs. Last point is a few comments on the sector outlook. So this strong rally of European markets was driven by new sectors. So we saw with the recovery of European markets a significant sector rotation. So this is the matrix I showed in my weekly report on Monday. So as you can see, significant re-rating underway on mostly cyclical sectors. So auto, construction, industrial is a very strong sector and one of the market leaders. Technology is also very strong and back to year highs in terms of relative performance. And on the other hand, so we started seeing profit taking on former leaders. So we continued until the start of this week, because it changed over the last few days. But we started to see a de-rating, so profit taking on the former leader of the market, which were financials, and also some profit taking on basic resources. So it seems that the new leadership of the market is mostly the cyclical part of the market. On the other hand, we continue to see lagging sectors. So these are the most lagging sectors. So media, retail, telecom move back to year lows in terms of relative performance, and also travel and leisure is becoming a market laggard. Thank you for listening, and have a good day. Bye.